SkillFront Certified Insurance Industry Fundamentals, CIIF, Eric Lefevre. Copyright 2021 by Eric Lefevre, all rights reserved. This book or any portion thereof may not be reproduced or used in any manner whatsoever without the express written permission of the publisher except for the use of brief quotations in a book review. First edition, March 2021. Contents: Introduction. What is insurance? What is at the core of insurance? What are the main business lines? What are the main insurance products? What are the main legal requirements for insurance? How do insurers make a profit? Claims management. How do we price risk? If I had my way, I would write the word insure upon the door of every cottage and upon the blotting book of every public man, because I am convinced, for sacrifices so small, families and estates can be protected against catastrophes which would otherwise smash them up forever. It is the duty to arrest the ghastly wastes, not merely of human happiness, but national health and strength, which follows when, through the death of the breadwinner, the frail boat in which the family are embarked, founders and the women and children and the estates are left to struggle in the dark waters of a friendless world. Winston Churchill. Introduction. History of insurance. When exploring some literature, we can find lots of interesting facts about what was done in the past to help people to protect either their physical assets, goods, boats or houses, but also their savings or lives. These facts would help anyone to understand some key insurance concepts and also why people are buying insurance. First, sorry for my British friends, the insurance business did not start in London in the 16th century with Edward Lloyd, it started way before that. When did it all begin? Thousands of years ago, the Chinese merchants were protecting themselves against the chance of a ruinous disaster in the Yangtze River by dividing their goods across several vessels to spread out the loss if one sank. Each boat carried a mix of cargo from several merchants. A single loss of a ship meant a small burden for all rather than a ruinous outcome for one. They most likely did not know the concept of insurance at the time, but they clearly understood the idea of sharing the risks. Risk pooling, or sharing, is a cornerstone of the business of insurance. If the risks can be divided among many members of a group, then the misfortunes, losses of one could be made bearable to all. We would call this a mutualization of risks, which lowers the overall potential for significant financial loss to any one person. See the illustration 1 below. Illustration 1, pooling of risk among 4 merchants. When did we see the first insurance regulation? In Babylon around 1790 BC, King Hammurabi enacted a compendium of 282 laws that set standards of conduct and justice for his empire in ancient Mesopotamia. In the middle of rules such as if a man knocks out the teeth of his equal, his teeth shall be knocked out, we can find a code addressing insurance issues. Rule 22 dealt with the robber. If anyone is committing a robbery and is caught, then he shall be put to death. Rule 23 provided a form of state compensation for the victim, which is a mutualization of the risk of robbery. If the robber is not caught, then shall he who was robbed claim under oath the amount of his loss, then shall the community compensate him for the goods stolen. They were also at the origin of marine insurance when enacting the concept of bottomry. Merchants could finance their shipping through loans from lenders. Upon the safe arrival of the goods, merchants were required to pay back the loan, also called principal, with interests. However, if during the trip the merchandise was lost, the merchant was not required to pay back the lenders. In a bottomry agreement, which is a risk transfer, the interest on the loan is the equivalent of an insurance risk premium. The higher the risk of loss, the higher the interest rate. The financial consequences of an existing risk could be transferred covered, for an amount, premium, to a third party. Today this would be called a risk transfer, the purchase of an insurance cover, effectively a risk of loss from the policyholder, the client, to the insurer. Bottomry was also practiced by the Hindus in 600 BCE and was well understood in ancient Greece as early as the 4th century BCE. The Romans went further in terms of guarantees for the shipment of goods. Titus Livy, 64 or 59 BCE-12 or 17 CE, said in his letters that the contractors who undertook to transport provisions and military supplies to the troops in Spain stipulated that the government should assume all risk of loss due to risks of the sea or capture, piracy. At the height of Roman power in the mid-2nd century AD, the empire had around 65 million people. Rome itself had a population of 1 million inhabitants, including 500,000 slaves. With such size, Rome could not survive without getting grains and food products by road, but more importantly by sea. Grain was shipped to Rome from Sardinia, Sicily, Africa, and Egypt. Oil was exported from Spain and Africa. To fund these ventures, the Romans put in place a very complex financial system which provided loans and a form of insurance. In other words, the Romans were encouraging people to take risks to ship goods or import goods by guaranteeing the payment of the bill in the case of an accident. Today, we can see similar setup with the export credit agencies which encourage their industry to export goods to foreign countries with the help of trade credit insurance. These loans were so conventional that the Romans developed standard contracts used for each voyage. Over time, a distinction took place between the ship and the merchandise. The ships were financed and covered under a bottomry agreement while the cargo was financed and covered under a respondentia agreement. Illustration 2. Bottomry agreement to finance and cover shipping risks. The risk of loss was with the lender, therefore, it was charging a high interest rate to cover the risk of losing the property, vessels or merchandises. The interest rate and the principal, the borrowed amount, were payable only if the boat and the merchandise arrived safely. The price to cover the risk of loss was paid after the event to be covered. Today, this amount is charged before shipping the goods, and we call this a marine insurance premium. If the boat is financed with a mortgage and the hull used as collateral, the marine insurance pays the lender in the case of a loss. When did we see the issuance of an insurance contract? After the collapse of the Roman Empire, limited trades took place in Europe, and it took several centuries before regular overseas commerce resumed. The 11th century marked a significant shift in Europe with the Northmen, Vikings, who settled down, and the rise of Italian port cities, Pisa, Genoa or Venetia. The Venetians and Genoese rapidly became the merchants of the Western world, and a dramatic increase of trades took place across the Mediterranean Sea. These Italian cities dominated the shipment of goods from the east to the west. By the end of the 13th century, the Venetians also sailed out past Gibraltar up to London and Bruges, where they exchanged luxury goods from the east for products of the north. The use of bottomry and respondentia helped the merchants to finance their ventures and furthermore cover their risks. Illustration 3. Bottomry and respondentia. At the beginning of the 14th century, having insurance cover for a ship and merchandise was an ordinary commercial transaction. It was only a question of time before the insurance cover was separated from the loan in a bottomry. In the Genoa archives, historians found a contract dated 1343 which provides evidence of the separation for an insurance feature, transfer or risk against a premium, from a marine loan. Genoa became the center of the insurance business, with insurance brokers putting in place such contracts. In addition to defining a standard insurance contract, the Genoese also gave some insurance guidelines. The insured must be the owner or at least have some interest in the covered property. When the sum to be insured was high, the Genoese made it possible for several persons to join the contract. They were adding their names to the contract with their proportion of the sum insured. Today, we call this a co-insurance arrangement. See illustration 4 below. Illustration 4. For co-insurers to cover a ship, by covering in a separate contract the risk of loss of goods against a premium, the Genoese put in place the first insurance policy. They also came up with the concept of co-insurance, which provides partial coverage along with other players. Today we define insurance as a contract by which one party, in consideration of a premium, undertakes to indemnify another party against a specified event. Insurance firms are also acting as co-insurers for very large amount to be covered. Over the following centuries, different types of marine insurance business took place in Europe, for example Barcelona, Bruges, and London. In the 16th century, the Lombards, immigrants living on Lombard Street, brought to the UK the word polizza, that is a promise, which is the root of the term policy, but also the know-how for pricing and managing insurance covers. Illustration 5. Broker General advertise on the 22nd of April, 1746 Lombard Street. The growth of England's foreign trade in the latter part of the 16th century and the use of insurance to cover the marine risks increased the need for this industry to be regulated, but also to accurately record the insurance policies. In 1575, the Office of Assurances was established in the Royal Exchange to coordinate and control the writing of insurance. A copy of every policy had to be copied into the policy register held at the office. Illustration 6. Extract of an English marine insurance policy of 1580 held in the library of the Institute of Actuaries in the UK. The policy starts with the following: Jesus in London, the 17th day of October 1580. In the name of God, Amen. Be it known unto all men, by these presents, That Dominic Butcher, merchant stranger resident in London, doth make assurance and cause himself to be assured, from the port of Weymouth to Rhone, upon 903 hides, 9,797 pounds of lead. Marine insurance started in Babylon thousands of years ago with bottomry arrangements. People already understood the concept of risk mutualization, risk sharing, and risk transfer to a third party against a premium. This practice was improved over the following centuries, and finally the Genoese in the 14th century AD put in place the first marine insurance contract. In the UK, they also understood the need to record insurance policies in a registry to avoid future disputes between the insured and insurers. This is still the case today. In most countries, insurers must maintain a policy record for each insurance contract or policy for several years after the cover ended. People understood that they would gain financial stability by transferring and pooling their risks. This encouraged more people to create wealth and undertake risky projects that they would not have considered. These were the seeds for the modern insurance industry as we know it today. We know today that an increase in individuals' wealth leads to a demand for wealth protection and investment products. With the rapid development of European trade and prosperity in the 13th century, cities in Italy and the Netherlands witnessed the creation of extraordinary wealth. Merchants were risking their money trading with others and used marine insurance to mitigate their most significant risk. But what about their wealth? As with property insurance, did we see similar trends thousands of years ago with the first creation of wealth under the Romans or the Greeks? There are lots of interesting facts relating the very early life insurance industry which could be found in Edwin Kupf's book, The Early History of the Annuity, published in 1929, and The Story of Life Insurance by Burton J. Hendrick, published in 1906. These two books are helping us to summarize what happened a long time ago. When did we see the first life insurance cover? In Greece around 300 BC, there were religious societies known as Eranoi and Thiasoi which were covering the expenses of their members' burials. Similar societies, called collegia, existed in Rome, where their establishment was attributed to Numa Pompilius, 753 BC 673 BC. The members of these mutual benefit societies paid an initiation fee and periodic contributions. The accumulated funds were used to help members of the group stricken by illness or accident, to pay for members' funerals and support their surviving dependents in death cases. A group of people exposed to similar risk came together and made contributions towards the formation of a pool of funds. The accumulated reserve was providing financial protection against losses that may incur in the case of death, illness, or accident. The Lanuvium Collegia's entry fee was at 100 sestertii plus an amphora of wine. The new member committed himself to pay monthly dues of 1/3 sestertius. If the member kept up with his monthly dues, when he died, the association would pay for his funeral expenses up to 300 sestertii, roughly 3 months' wages. Illustration 7, Collegia Fund Accumulation. The collegia had to get additional funding to serve their future liabilities. They were most likely also relying on the members who stopped paying their fees. Policy lapsing. For instance, if a person started paying at 20 years old and died at 60, the collegia collected 180 sestertii, 100 plus 4x20, which was not enough. The collegia had to find a way to cover the gap. We have found evidence of collegia that were investing their funds to sustain their expenses. In one inscription from the reign of Antoninus Pius, 86 AD 161 AD, the donor gave 50,000 sestertii in coins to the Collegium of Aesculapius and Hygiea near Rome, with instructions to the 60 members of the association to loan out the funds and use the returns to fund their feasts and other activities. Illustration 8, Collegia Fund Accumulation. Through money lending and real estate investments, the collegia could increase their pool of funds for covering their future obligations liabilities. Insurers are doing something similar today. They collect premiums and place them into an investment pool. They use the premiums collected to fund investments, generally in guaranteed or low-risk securities due to regulatory restrictions. When a claim is made, the money is taken from that pool and put into a cash account to pay the claim. When were the first annuities put in place? We define an annuity as a fixed sum of money paid to someone each year, typically for the rest of their lives. Illustration 9, Annuity Payment. There is plenty of evidence in the response of Elpinus, in the Digests of Justinian and in the Basilicon of Basil that the Romans were continually buying or selling annuities, referred as annuum, both for life and fixed terms. In return for a lump sum payment, these arrangements promised to pay the buyers or their designated beneficiaries a fixed yearly income for life, or sometimes for a specified period. In the Lex Falsid, 40 BC, there were provisions that the heir or heirs of an estate should receive not less than 1/4 of the total property left by a deceased person. When a dead person had left a life annuity to one or more beneficiaries, the main challenge was to capitalize the annuities. To resolve this issue, the Romans used a life expectancy table known as the Ulpian's table. The Roman Domitius Ulpianus, 170 AD-223 AD, created the very first actuarial life table, Ulpian's table. In this table, the life expectancy either represented a median life expectancy, that is, the number of years elapsed before half the selected population is dead, or a discounted. Table 1, life expectancy as per Domitius Ulpianus. For 45 years old, the expectancy would be 60. 45 minus 1 equals 14 years. The Ulpian table was the official annuity table of the Tuscan government in northern Italy until early in the 19th century. Life expectancy tables are used to determine the present value of an annuity payment. Arithmetic and statistical material were required to come up with the adequate discount rate. Today, the cost of a life insurance cover depends mostly on the probable length of one's remaining life. Insurance firms use a mortality table which provides the rate of death among a defined. After the fall of Rome, 4th century AD, the money economy which the Romans had set up almost disappeared, and the then known world became a goods economy. However, this did not stop the business of issuing annuities. How did life annuities evolve after the fall of the Roman Empire throughout the Middle Age? During the 8th century, monasteries and other religious organizations gave land in return for payments of money. The Council of Seleucia in 816 AD laid down a rule that the lands of the church should not be charged for more than the term of a single life. Illustration 10, usage of land in return for payment. At that time and throughout the Middle Age, the life annuities were used to raise capital and were a form of debt owed by the towns or states. The annuity was payable for the duration of the beneficiary's life, or beneficiary's life. It is also worth mentioning that in the case of death, the payments to heirs could also take place. In 1308, the abbot of Saint Denis arranged with the Archbishop of Cologne to pay a life annuity of 400 livres to the Archbishop in consideration of 2,400 livres paid to the monastery. In the event of death during the first 2 years of the term of the annuity, 1,000 livres were to be repaid to the heirs of the Archbishop. Illustration 11, annuity with death benefits. In the archives of Flemish municipalities, for example Tournai, we can find evidence of annuity arrangements which were dated back to 1229 AD. For instance, in Bruges, Robert Norman and his son Bourdoin arranged for a survivor annuity of 400 Parisian livres in February 1265. They provided that if the purchasing power of the Parisian livres declined, the payments were to be made in the sous of Tournai at the ratio of 50 to an sous to 48 Parisian livres. Illustration 12, cost of living adjustments to an annuity. In an annuity contract, a distinction could take place between the money income and the real income, for example the future money's purchasing power. Today, insurers are offering to their customers the possibility to add cost of living adjustments, COLAs, to an income annuity contract. The COLA could either be a level increase, for example a constant 3% adjustment, or a consumer price index, CPI, adjustment. The CPI is updated the 1st of January of each year, and the annuity income can either increase or decrease for that year based on the change in the CPI index. We can find mentions of annuity arrangements in the archives of municipalities and policies to identify frauds. In Leiden, Netherlands, an annuity certificate on file for the year 1402 contains a death certificate signed by a physician. Measures were taken to encourage the prompt reporting of deaths of annuitants. In the middle of the 16th century, people who reported deaths of annuitants or frauds were rewarded. A manuscript for 1449 showed that half-yearly payments were made in June and at Christmas. An official of the town would search out persons entitled to annuity payments, post a notice on the church door, set up an office and then tell the annuitants to call for their money. Illustration 13, fraud avoidance, face-to-face payments of an annuity. The identification of deceased annuitants was a challenge for the borrower, thus the need to rely on their declaration and to reach out to the beneficiaries by available means. Today, insurance companies are relying on their mortality table for flagging policies, and depending on the countries, they also have access to specific social security databases which help them to identify if a client died. When someone dies, it is often the responsibility of the beneficiaries to claim the money in a policy. Insurers are not required to seek out the beneficiaries. What are the other forms of annuities issued to finance cities and states? In the 15th century, in addition to life annuities, European states and municipalities issued perpetual annuities to finance their wars or operations. We can find numerous information on these arrangements in France or German. In France, in 1522, perpetual annuities called rente were floated at 8.5%. The collected tax on wine secured the annuities. In Germany, around 1530, the city of Nuremberg borrowed on perpetual annuities at 5%. A perpetual annuity was a contract put in place between a borrower and a lender. The borrower promised to pay a fixed amount every year forever to a lender. The borrower's only obligation was to pay the specified amount. He could, however, at his option, choose to end the contract by repaying the purchase price, the amount which was initially borrowed. We would see this today as a perpetual bond with a call option. The perpetual annuities were secured by revenue streams such as collected tax. At the Renaissance and after, annuities were used as fundraising vehicles for European states and towns and were popular. The governments were using these schemes for financing their war efforts and projects. In 1721, the French state was not able to fulfill its obligation with a total debt of roughly 2 billion livres, and a restructuring took place. Out of the 2 billion, approximately 50% were perpetual annuities. The states and towns were financing their projects and wars with the issuance of annuities, a form of debt directly to individuals. Today, governments are issuing bonds to finance their budget deficits and are not issuing annuities anymore. They are also issuing project bonds to finance infrastructure-related projects. The buyers of these bonds are mainly pension funds, insurers, mutual funds, foreign and domestic, central banks, investment banks. Due to regulations, individuals' insurance premiums or savings plans, including pension funds, are partly invested in these bonds. In the 17th century, people could buy another form of annuities. Lorenzo Tonti, a Neapolitan banker, proposed a new scheme to Cardinal Mazarin to resuscitate the French finances. The proposed investment plan, a Tontian, combined the features of a group annuity and a lottery. Each subscriber was to pay an agreed sum into the pool and after that to receive an annuity. As members died, their shares were split among the other participants, and so the value of each annuity increased. On the death of the last member, the scheme was wound up. By an edict dated the 2nd of December, 1689, King Louis XIV created a tontine royale and raised 1,400,000 livres on his first tontine plan. The tontine invited subscriptions, at 300 livres each, to a general fund. The French kingdom agreed to pay the total interest on this fund to all surviving subscribers. Each member's share of the income was to cease at death and revert to those who still lived. Each member's revenue increased in proportion to the debts of their associates in the scheme. This scheme was the equivalent of a state loan upon which interests were paid to the subscribers and which was entirely liquidated when the final survivor died. The interests to be paid were increasing over the years. The tontine met all its obligations, even after the 1721 debt restructuring, and continued until 1726 when the last survivor, Charlotte Bonhomet, widow of Louis Barbier, died in her 96th year. At the time, she drew an annual income of 73,500 livres, in return for an initial subscription of 300 livres. Illustration 14, Tontine Scheme. How does a tontine work? Let's assume a tontine put in place in 1710 with 100 people paying $10,000 each, for a total of $1 million and a yearly 7% payout, which means a $70,000 dividend every year. As long as the 100 people are alive, each would receive a 1/100 share of the total dividend, meaning $70,000 100 equals $700, which is a 7% payout of their $10,000 initial investment. However, if after 20 years only 50 people are alive, the $70,000 annual payout would be split amongst these 50 people, which means a dividend payment of $70,000. 50 equals $1,400 per person. As more people pass away, The tontine payments to the survivors continue to grow, with the final few participants receiving substantial dividend payments in their final years. For example, $70,000 for the last survivor, pretty much what Charlotte Bonhomet received from the French state. In 1670, the Dutch city of Kampen floated a tontine of 100,000 florins in 400 certificates of 250 florins each. Jacob van Dale set up the tontine and published prospectus with a prospective survival table of the 400 annuitants. See Table 2. Table 2, Van Dale's survivorship table. From the 6th year on, the decrement is 1 death for each year of experience in the original table. Van Dale suggested that no interest be paid to pool members until 24 years had elapsed, then 15% was to be paid. After 36 years, 32%, after 73 years, 400%, and after 80 years 1,600% was to be distributed to the survivors of the original 400. See Table 3. Table 3, interests to be paid in the Kampen tontine. If we follow the assumptions of the tontine and compute the annuities per year, we will see that the tontine would have run out of cash after 74 years if the initially collected pool was not invested. See Table 4 for payout estimates per period. Table 4. Projection of the Van Dale scheme under the assumption that the pool of cash is not invested. If the collected cash were invested at 5% per year without being used for covering any expenses, the town would have had more than 300,000 florins in hand at the end of the first period, which was more than enough for covering its obligations the following years. At the end of the 17th century, the issuers of annuities started moving from offerings which were based on experiments and trials to a more systemic approach based on mathematics, for example understanding of compound interest, probabilities, and mortality tables drawn from the experience of populations. The 17th and 18th centuries were a transition period to modern life insurance based on actuarial calculations and tools. We are now using period life tables for life insurance. These tables are built with the mortality experience of a population during a short period. With wealth creation, people were looking at opportunities to protect and grow their savings. Over the past, apart from the Romans, there has not been that much pure life insurance protection, the payment of a sum of money at the death of the insured. There could be several reasons for this, one being that they did not have the statistical knowledge nor accurate mortality tables to price the risk of death accurately. They were missing the probable duration of the insured's life. Life insurance as we know it today started in the 19th century, with the possibility for people to get their risk of death covered against the payment of premiums during their lives. What is insurance? Insurance basics. This sounds an easy question to answer, yet some years ago, I saw many senior insurance executives having difficulties in answering such basic question. Most of them answered this question with a very long monologue which made the subject seem overly complex. The issue for these executives was to provide the big picture. They were experts in their field, thus they're urged to share their knowledge and get into complex discussions. We will simplify here the topic. In our views, we should see insurance as a transfer of risk from one person or business, a buyer, to another party, an insurance company. This transfer of risk is done against an amount of money, called a premium. This transfer of risk is a protection. The insured buys a protection against the risk of an uncertain loss. Against the paid premium, the insurance company will cover the buyer's risk. When a guaranteed event occurs, the insurance company pays the insured for the damages, for example a fire which would destroy a house. Insurance is a hedge against the risk of an uncertain loss. A transfer of risk takes place from the insured to another party. A paid premium is used to buy this service, which is a protection. An entity or person which provides an insurance cover is an insurer, an insurance company, an insurance carrier or an underwriter, who are providing insurance covers. The answer seems obvious, insurers, but what are their types? Putting aside the need to have an insurance license in order to be able to issue an insurance cover, in theory anyone could be an insurer. There are different types of insurers, with the main difference being their ownership structure. The privately owned structures, these are insurers whose shares are publicly traded. These insurers are paying a dividend to their shareholders based on their yearly financial results, for example AIG, Chubb, AXA, Zurich, Allianz, Generali, etc. Some insurers may have few shareholders, for example Partner A owned by Exor. The policyholders owned structures, these insurers are often called mutual companies. These insurers are also privately owned, but the shares belong to the policyholders. the yearly profits are returned to the policyholders after having set aside a surplus. The state-owned structures, in some countries, the state could also act as an insurer. The Social Security, unemployment schemes are providing an insurance coverage to people. What is at the core of insurance? The law of large numbers. The law of large numbers is at the core of insurance. By having a large enough number of insured in an insurance pool, adding together their premium, the insurers are able to sustain future losses. The size of the pool is directly linked to the predictability of the losses. Insurers are not different from other businesses. At any time they must be able to meet all their obligations vis-à-vis their clients, the insured, their employees, their suppliers. Without a sound cash flow planning and a large enough risk pool, the insurers could be without enough money to fulfill their future obligations. See example 1 below to illustrate the importance of pooling premium. Example 1, Amy and INSA. Let's consider a person, Amy, who bought last month from INSA, a property insurance to cover her house and its content against the risks of fire, theft and some weather damage. She paid a $1,200 premium for a 1-year cover and signed all the necessary documents. Today, Amy declares to her insurer a fire which damaged half of her property for a total loss of $120,000. If Amy was the unique client of INSA, she would most likely be in trouble as the insurer would not be able to fulfill its obligations and cover the claim. However, if we assume that over the past year, INSA managed to sell the same type of products to over 1,000 clients for an average premium of $1,200 and that Amy is the first client to declare a claim, INSA would not have any problem to fulfill their obligations. Pool of premiums to pay claims to policyholders. The more people buy an insurance cover from INSA, the more their risks are shared, and the higher the chances that what INSA pays out as compensation is lower than the money collected as premium. By being able to pool together the risk of many customers, and their premiums, the insurers can increase their likelihood to fulfill their obligations and compensate their clients when they have a covered loss. Insurers are not gambling. It was probably the case in the early days of insurance but not anymore. The premium charged by an insurance company is based on I. The probability of an accident happening, which provides what would be paid in the future, 2. The cost of running the company, and 3. The margin charge for the service provided. What is the law of large numbers, and its application to life and damage insurance? In 1713, the Swiss mathematician, Jacob Bernoulli demonstrated that the law of large number was correct in his book Ars Conjectandi. The law of large numbers, LLN, describes the result of performing the same experiment many times. According to the law, the average of the results obtained from a large number of trials is close to the expected value and tends to become closer as more trials are performed. We all know that when we flip a coin, there is a 50% chance that it will come up heads, and a 50% chance that it will come up tails. Of course, sometimes, when we flip the coin a small number of times, there is a chance that we get 4 heads in a row or 4 tails in a row. But, most of us know that if we flip the coin 1,000 times, we will most likely end up with the coin being roughly 500 times heads up. As mentioned in our previous chapter, this is at the core of insurance. As the number of policyholders increases, the probability is higher than the actual loss per policyholder will equal the expected loss. The higher the number of policyholders, the easier it is to establish the correct premium and anticipate future losses. An insurance company is better off issuing 1,000 fire insurance policies rather than 100 fire insurance policies. See the example 1 in our previous chapter. We will use an example to further illustrate how the insurers are using the LLN to anticipate future losses and ensure that the collected premiums are correct. Example 2, INSA fire insurance cover. We mentioned Amy's case earlier. Let's assume that, using their own statistics, INSA's actuaries looked at the losses which occurred in the past and predicted that, in any given year, approximately 10 out of 5,000 policyholders will file a fire insurance claim. This means that if INSA writes 10,000 fire insurance policies, it expects to pay 20 claims. This is called the frequency. In addition to the frequency, based on their claims experience, the actuaries can estimate the average cost for the fire insurance claims. They are predicting that the average claim is $195,000. Therefore, for the year, the total loss estimates would be $3,900,000, 20 times $195,000. Based on the LLN, the insurers know that as the number of policyholders increases, the more their prediction will be correct in terms of future claims frequency and severity. Unfortunately, the law of large numbers does not prevent insurers to be wrong with their assumptions or having higher losses in a given year. In addition, this does not explain why some insurers are performing better than others. What are the main business lines? Life insurance and non-life insurance. On one hand we have damage insurance, also called general insurance or non-life insurance, and on the other hand life insurance. General insurance products help people to protect their possessions, such as their homes, cars, but also factories and other physical goods, for example cargoes, but also non-physical risks, for example business interruption. These insurance contracts are indemnity contracts, which means that if a loss, accident, does not occur, the insurers do not have to pay anything. The promise to pay only applies when a covered accident occurs. The liability materializes only when a loss takes place. There are two types of life insurance products. Those which are pure protection policies, for example payment of a benefit in the event of death, and 2. Savings policies, for example the growth of capital with regular or singular premium invested in specific asset classes, combined with the death cover. In the case of life insurance contracts, death covers, there is a certainty, if the policy does not lapse, that the insurer will have to pay an agreed amount to the beneficiaries. The only unknown is when. Although the mortality tables provide some indications, since the insurer has undertaken an obligation, there is a liability even if there will not be any payment of a death benefit for 30 or 40 years in the future. For this obligation, the insurers have to put some money aside in reserves which will be used to fulfill their future obligations. The insurers are saving like squirrels. It is well known that some squirrels move thousands of nuts among 5 or more locations to discourage pilfering by rival squirrels. By avoiding losses, squirrels reduce their risk. The insurers, like any investors, do the same thing by diversifying their portfolio. Rather than putting all their reserves in one basket, they spread their investments across multiple types of assets. They diversify their investments by including stocks, bonds, and cash in their portfolios. As mentioned earlier in this book, insurance is primarily a liability-driven business with the need for insurers to purchase the right assets to match their estimated future insurance obligations. Their obligations to pay the future claims covered under the terms and conditions of their products. Life insurers have longer liability duration than P&C insurers, which have short-term liabilities except for some long-tail business lines. P&C insurers are mainly managing their short-term needs in terms of liquidity, that is short-term investments which can be easily converted into cash to pay the claims. What are the main insurance products? Retail and corporate commercial. For non-life insurance, damage insurance, we should split the products into those offered to individuals and those offered to corporations. We refer to these categories as personal lines, which are products for individuals or families, for example auto, household insurance, boat, travel, etc. Commercial lines, which are for corporations, for example property and casualty, liability, marine, machinery breakdown, directors and officers, etc. In the US, for the year 2017, the net premiums written for personal lines represented 55% of the total market, thus exceeding commercial lines, $billions. Insurance training learning. Personal lines insurance includes products such as homeowners insurance, flood insurance, earthquake insurance, renters, tenants, insurance, car insurance, life insurance, disability insurance and health insurance. These insurance products protect individuals and families against financial losses caused by fire, thefts, natural disasters, death, accidents, lawsuits, and illness. Insurance training learning. Commercial lines insurance offers several types of covers, such as car fleet, workers' compensation, flood, fire, machinery breakdown, business interruption, ocean marine, medical malpractice. These covers protect corporations against the potential losses caused by accidents. The covers and premiums are a function of the business type, size and location. What are the main products per type of customer to know? What is the size of the global insurance market? Outside the United States, the insurance industry is divided into life and non-life, or general insurance, rather than life annuities and property casualty. The world insurance premiums rose 2.9% in 2019, adjusted for inflation, to $6.3 trillion. Non-life premiums grew 3.5% in 2019, adjusted for inflation, slightly above the rate of growth from 2009 to 2018. Life insurance premiums grew 2.2% in 2019, faster than the 1.5% rise in 2009 to 2018, adjusted for inflation. The global motor insurance market is estimated to be more than $880 billion in 2019, 25% of total non-life. This is the largest market and profit contributor for insurers. What are the main legal requirements for insurance? Some rules. Whether the products are for individuals or corporations, there are few rules that need to be fulfilled in order to have an insurance cover. As already mentioned earlier in this insurance training, the insured pay a premium to secure themselves the payment of a benefit upon the happening of an event. It is necessary though that this event involved an amount of uncertainty. The insured must have an interest in the risk covered, regardless of the type of cover. In case of loss, the insurer's payment is to compensate the insured to the extent of his loss, and not to enable the insured to make a profit. This rule applies to life insurance and damage insurance. Excess deductible retention in most insurance policies. The insurers do not cover a small part of a loss. For instance, in a case of glass breakdown, an insurer may require the insured to pay the first $100 of a loss. This amount is often referred to as a deductible, an excess or a retention. Often, the insured could buy back this deductible but for a rather high premium. In an insurance policy, the deductible is the amount paid by the insured before the insurer pays any expenses. Limit of insurance cover. The insurer will provide a financial limit to a cover. This limit could be either per claim or aggregated for all claims in a given period. Under a household cover, the insured's liability could be $5M, whereas a cyber insurance could be limited to $300K. The limit of liability is the maximum amount for which an insurer is liable under a given contract. New for old insurance policies under these conditions. In the case of a covered loss, the insured would get a payment to get a new equivalent item. The insurer will not deduct anything for the age of the item. New for old insurance cover will provide an insured with a new equivalent item, regardless of the age of his original item. The key word to note is an equivalent item. Commencement of the insurer's liability. The period of cover will start immediately upon the purchase of the insurance contract. The contract may state a different start date for the cover than the date of the transaction. In some countries, the cover may start only upon the payment of the premium. In other countries, the cover starts even if the premium has not been paid. For example, in France, the insured could be covered up to 50 days without having paid his premium. Payment of an insurance premium. The insurers are collecting from their customers the premium upfront and fulfill their payment obligations. Deliver the product only when a covered claim occurs. The insurers have an inverted production cycle. This inverted production cycle creates opportunities and obligations. The insurers have the ability to earn an investment income on collected premium until having to pay a claim. The etymology tells us that premium comes from Latin premium with I, pre meaning before, see pre, and to, emere meaning to buy. Premium could mean buy before, which is what customers do when they buy an insurance cover. Payment before the delivery of a service. Getting paid before delivering a service brings opportunities, investment opportunities, but also challenges. The insurer should not recognize the total premium paid up front as a full revenue, and they need to recognize it as the services are provided. We will cover this aspect in a separate chapter. As mentioned in our previous chapter, insurance is a liability-driven business. When an insurer receives a premium, it has to recognize a liability vis-à-vis its client, the money owed to the client for an uncertain service which could be delivered in the future. The key questions being, when will the service be delivered if ever? When are the insurers able to fully earn the paid premium? For how long shall last a liability? We could have insurers who do not put aside any cash for future claims. In this case, these Ponzi insurers would be insurers which use the newly collected premiums for paying the past claims. However, the regulators would not let this happen. Insurance training learning. By law, insurers must set up balance sheet reserves for ensuring that they can pay any claims, losses or benefits promised to their customers. It is worth noticing that depending on the country when starting an insurance company, the capital requirements would be in the range of $5 to $10 million, before even issuing any insurance policies. Insurance contract. When a customer buys an insurance cover, an insurance contract is issued. This is the only physical product that the insured will receive. A record is also entered in the insurer's systems. When an insurer sells an insurance cover, via an agent, a broker or online, it is about selling a contract which is enforceable by law. The insurers are always following the below legal requirements. 1. Issuance of a quote which stipulates what will be covered and the price to be paid, the premium. The client has to accept the proposal and can modify it when required. For example, risk description and covered item. Any changes to the proposal will require a new proposal as the premium may change too. The parties who sign the contract must be competent. Every person is competent to contract if she, I, is of the age of majority, 2, is of sound mind, and 3, is not disqualified from contracting by any law to which he is subject. 3. The contract must be legal. A contract is only deemed legally binding and enforceable when its purpose is allowed by law. The law cannot be used to enforce illegal activities, rather obvious. 4. The contract must be in legal form. Elements of an insurance contract. As mentioned before, the insurance contract will have an offer, an agreement, a description of the insured items, the coverage, the requirements for both parties, level of protection required for the home, and the requirement that each party is legally responsible. The contracts will also provide a list of exclusions, which are the elements not covered in the contract, the risk of war being a classic exclusion. How do insurers make a profit? Cash flows. Financial operations of an insurer are to be viewed in terms of a series of cash in-house, income, and out-house payments. The in-no components are added to the pot of assets, while the reserve is depleted by the out-out components. The insurers must ensure that at any time their pot never get empty, dry. In other words, they must remain solvent. See the illustration 28 on the following page. The main in-no components for an insurer are the premiums, which are the primary incomes, the income from investments, for example interest payments, dividends, rents from owned properties, gains from assets such as shares, etc., the recoveries of claims from reinsurers. When an insurer transfers some its risks or parts of risk to a reinsurer, the issuance of new capital to shareholders. The main out-out components for an insurer are the payments for claims, the reinsurance premiums, thus the recoveries of claims described earlier, the expenses which cover the commissions paid to the distributors, the administration and operating costs, the taxes paid when realizing a profit, the dividends paid to shareholders, or surplus for a mutual insurance company, and the bonuses paid to policyholders, when profit-sharing schemes are in place. The insurance cauldron. The consequences of under-reserving could be dramatic for an insurer, especially for the monoline insurers. Strengthening of reserves for prior accident years or lack of premium reserves can significantly reduce the company's earnings. Regulators have imposed a solvency risk model to ensure that insurers have the necessary buffers to be better able to withstand significant losses and unknowns. However, the insurers need to come up with the right premiums to cover the risks of their clients. Claims management tasks of an adjuster. The goals of the claims function within an insurance firm is to keep the insurer's promise made in the policy, but also to ensure that the pot described earlier in this training is secured. Claims represent the largest expense for insurers, which is, of course, understandable. After all, this is what their clients are expecting. People purchase property casualty insurance policies to protect against financial losses. When policyholders make claims under their insurance policies, the insurer has to indemnify the policyholder for financial losses. This does not imply that the insurer should or will pay every claim that is presented. Rather, it implies that the insurer's claims department will conduct a good faith investigation of a claim and pay only legitimate claims that are covered by the policy. In a property insurance policy, the insurer's promise is to pay for direct physical loss to covered property by a covered cause of loss. In a liability insurance policy, the insurer's promise is to pay on behalf of the insured any damages for which the insured is legally liable because of bodily injury, property damage, or other specified types of injury caused by an accident, up to the applicable limit of insurance. The insurer also agrees to defend the insured against claims or suits seeking damages covered by the policy. The first person from the insurer that the insured talks to, when he or she suffers a loss, is a claims handler, also called adjuster. This claims handler helps the insured to declare his/her loss and to share the necessary information to get an indemnification. With our current technology, this claims handler could be a so-called robot which processes automatically the customer's requests. This claims handler, or another one, will investigate the loss, Interpret the policy wording, and apply the policy wording to the facts discovered while investigating the claims. The management of the claims encompass usually 6 main steps. First step, read the policy to understand the policy of insurance. The handler must read and analyze the policy in a logical and thorough manner. The facts of each individual claim clarify and color the interpretation of the policy contract and bring different nuances to the policy wording. The claims handler must know what coverage is available to the insured, the limits of liability, the territory limitations, and the exclusions, conditions, and endorsements attached. Before beginning to investigate a claim, the claims handler must first establish or confirm the coverage. To do this, he or she must get the policy number and check whether the insurance premium has been paid and that the loss is covered. This could be done with the help of the available information in the systems or with a copy of the policy. The claims adjuster must also determine the policy limitations and determine the perils insured against. The claims handler must be familiar with each of the exclusions or exceptions from coverage. Second step, read the first notice of loss. The notice of loss notice is one of the most important documents the loss adjuster will see. It is the starting point of all claims. It tells the adjuster when the loss occurred, the type of coverage the insured has, the type of loss, the insured's name, address, contact details, the location of the loss, who to contact and how to contact him or her, whether there is anything to which the claims handler should give special attention. Third step, agree or decline the coverage of the loss. The claims handler will inform the insured whether or not her loss is covered under the policy. Fourth step, obtain the proof of loss. The insured must demonstrate the proof of loss. For motor, this will be the reparation estimates which would be delivered by the garage or an insurance expert. The insurer will request the final bill for the reparation. Fifth step, pay the claim. The insurer will indemnify the insured or pay directly a garage when the claim is related to a car accident. For third-party liability claims, the insurer will pay the third party. Sixth step, recover when possible some of the costs depending on the claims. The insurer may have the opportunity to recover part of the claims from third parties, for example in the case of a car accident where the insured was not responsible of the accident. For major claims, especially for corporate property claims, the insurer could also recover some of the costs from their reinsurers. Thanks for learning with the SkillFront. I want to thank you for taking the time with our program. We hope you enjoyed studying this lecture as much as we had enjoyed while we were creating it. It would be our greatest pleasure if we managed to help you to learn a thing or two, which will guide you on your own exciting entrepreneurship journey. This program is a playbook. Don't just study it once and go on with business as usual. Keep it handy and refer to it often. Having these tactics and using them hand in hand will give you strategies to grow your business and career geometrically. And with that, thank you so much once again, and I wish you all the success you can dream of. SkillFront, what's coming next? If you want to get up-to-the-minute ideas, keep yourself informed about SkillFront programs like this one, follow our pages on LinkedIn, Facebook, Twitter, and Instagram. SkillFront, our web address, www.skillfront.com.